The U.S. Federal Reserve cut interest rates by 0.25% on the last day of the month and also announced that they would stop the process of shrinking their balance sheet 1 month sooner than expected. The market volatility began 30 minutes after the announcement when Fed Chair Jerome Powell began his press conference. During the conference, he characterized the rate cut as a mid-cycle adjustment, as opposed to the beginning of a longer rate cut cycle as markets had hoped. As he was talking, the U.S. stocks sold off almost 2% until a reporter during the Q&A session was able to alert Jerome Powell of the market movements and give him the opportunity to walk back some of his comments. Markets were able to recover some of their losses and end the day down roughly 1%. Global equities and U.S. interest rates moved sideways for most of July, despite some notable central bank and global economic developments. Advanced estimate of U.S. GDP showed economic growth slowed from 3.1% in the first quarter to 2.1% in the second quarter. This 2.1% growth figure was slightly better than expectations due to continued strong household consumption data. European Central Bank President Mario Draghi opened the door to interest rate cuts as soon as September. Market reaction was relatively mixed following the announcement, as investors started to question how effective an interest rate cut from negative 40 basis points to negative 55 basis points could be in terms of stimulating economic growth. As a result, many investors, including CSIG, believe that the European Central Bank will likely have to increase asset purchases in order to stimulate markets in the economy by continuing to buy sovereign bonds, corporate bonds, and down the road, potentially even buying equities. Finally, the Trump administration kicked off the month of August with fresh tariffs of 10% on the remaining $300 billion of Chinese goods that the U.S. imports. This announcement set equities markedly lower and interest rates lower. We're seeing signs that the economic slowdown experienced outside the U.S. since mid-2018 is beginning to impact the cyclical areas of the U.S. economy, such as manufacturing and industrial production, and continuing to have a negative impact on expectations for U.S. corporate earnings. These factors, combined with further escalation of trade tensions between the U.S. and China, means that there's a tremendous amount of pressure on the U.S. consumer and the Fed to keep U.S. economic growth steady and keep markets near all-time highs.